And welcome to Valid Capital. Today, in continuation with yesterday's topic, I will be explaining you about the debt. That is, yesterday I have told you the HDFC multi-asset fund, and in the first part it was about the equity, and today the second part, that is why debt. While equities provide capital appreciation over a longer time horizon, the debt provides better stability to a portfolio. The equities do generate higher returns than the debt. However, the debt is significantly less volatile as compared to the equities. Please do refer this chart below. Now I am going to tell you the factors supporting the lower yields and also the factors opposing the lower yields. First, move on to the factors supporting the lower yields. That is, RBI and major central banks likely to continue with accommodative stance and low rates. Uncertainty over global growth outlook remains due to description and the risk of second wave of infections. The third one is commodity prices likely to be a range bound given the weak growth outlook in near term. And the fourth one is unconventional tools used by the RBI to improve the transmission of rate nets. That is Operation Twist, LTROs, Target LTROs. And the fifth one is the muted credit growth versus the deposit growth, ample global and domestic liquidity. The second part, that is what is the factors opposing the lower yield. In that part, the first point is excess SLR securities holding of PSU banks, the larger supply of the dated securities by the central governments. Near-term inflation likely to remain above the RBI at 4%. And economic activity showing the sign of recovery will improve the sequentially. Moving on to the third part, that is attributes of gold. A scarce but liquid asset with no credit risk. Low or negative correlation with other asset classes. Tool to effectively diversify the portfolio. Considered a hedge against the inflation and currently the devaluation. Safe have asset with resilient performance during the volatile market conditions. To get a brief idea about the gold and low interest rates, please do have a check over here. The economic fallout of COVID-19 has hampered the growth prospects globally. To stimulate the economic growth, the central banks around the world have further reduced policy rates from already the subdued levels. As can be seen from the chart to the left above, 87% of the major central bonds, that is covered by the BIS, have cut policy rates in 2020, highest level since global finance crisis. Chart to the right above indicates that the increase in negativity yielding debt generally or globally has increased the popularity of the gold. The global economic slowdown and the low interest rates increases the popularity of the gold as a safe haven asset. Gold as a hedge as a currency depreciation. The returns from the gold in domestic currency terms, INR, are functions of gold prices in USD, currency fluctuations of INR versus USD. INR depreciation increases the returns from the gold and vice versa. The gold acts not only as a safe haven asset but also as a hedge against the currency depreciation and inflation. The graph which shows on my left side indicates the gold return CAGR percentage, that is from April 1998 to July 2020. Now let's have a check about the different asset classes outperformed at different times. Historical returns tend to bias the investors towards the asset classes that has performed well recently. The recently bias could result in investors chasing momentum and picking an asset classes at an inopportune time. Over the last 22 fiscal years, equity, debt and the gold have outperformed each other at different times. Also, the different asset classes have different risk profile. Equity returns are relatively more volatile, that is vice versa, debt and gold. And also, the debt is less volatile than both equity and gold. The next one is correlation and diversification. Asset correlation is a measure of how asset classes move in relation to one another over a period of time. Correlation coefficient can range from -1 to +1 when asset moves in the same direction at the same time. They are considered to be positively correlated. When one asset tends to move up when the other goes down, the two assets are considered to be negatively correlated. Daily 1-year rolling returns since April 1998 exhibit the negative correlation between the equity, debt and gold. The low and the negative correlation between these asset classes creates a strong case of diversification. By combining the negatively correlated assets, the investors can reduce the risk significantly without compromising on returns. What is asset allocation and why it is needed? The asset allocation refers to distributing your investable surplus across the various asset classes according to the risk tolerance, risk appetite and the investment time frame. Why asset allocation is crucial? Each asset class behaves different across the different economic cycle. It reduces dependency on a single asset classes to generate the returns. That reduces the volatility of returns of portfolio. How can investors implement asset allocation? Determine the financial goals, ascertain the risk appetite, determine the optimal asset allocation, invest in different asset classes directly or invest in a hybrid mutual fund. Rebalance the portfolio periodically. Now let's have a look about the power of asset allocation. Let's have a check about this graph. That is, let's consider the growth of investment rupees 1 lakh from April 1st, 1998 to 24th July 2020 along with the volatility of returns over that period. How the numbers stack up? That is, the gold and equity performed better than the debt in terms of the returns while the debt had the lowest volatility. However, could you have got a better deal for your investment? Yes, a combination of equity, debt and gold would have yield returns higher than individual returns and that too with lower volatility, thereby underlining the importance of asset class diversification. Why we need a multi-asset fund? Asset class returns vary over economic cycles. Investors exhibit a recently bias and investors invest in recent outperformance. Timing the market for various asset classes is different. Lack of diversification leads to the higher volatility of returns. Combining negatively correlated and the less correlated asset classes reduces the portfolio risk. And also, the multi-asset fund meets the asset allocation needs of investors efficiently. HDFC multi-asset fund aims to generate the long-term capital appreciation and the income by investing in a diversified portfolio of the equity and equity-related instruments, debt and money market instruments and gold. That's all for today, and if you are having any doubt regarding this topic, you can easily comment in our comment box and our experts will be replying within a minute. And also, if you people are watching our video for the first time, please hit the bell button too. And also, subscribe, like and share. And at last, I would like to wish each one and your family a very happy Onam from the Violin Group. May the spirit of Onam remain everywhere in whatever you do, whatever you think and whatever you hope in your life. May this Onam be the forerunner of good luck and joyness and may it bring you joy that lasts all year. Happy Onam everyone.